Hi, this is James Shug with Westpac London's end of day report for Tuesday, April the 30th. Look, markets aren't that exciting today, up and down all over the place. I'll run through the numbers in a minute, but there was lots of news that's worth reporting, some of which has influenced expectations about, certainly European Central Bank policy. We've got the ECB meeting coming up this week on Thursday. In Europe, we saw the flash estimate of April inflation for the Eurozone. It fell from 1.7% to 1.2%. Now, the last time it fell to 1.2% was in 2009, when the European economy was in the depths of the recession. Given the inflation, or the definition of price stability that the European Central Bank has is close to but below 2%, at 1.2%, the case for some form of policy stimulus clearly has strengthened. We also had unemployment figures today, which showed a yet new record high of 12.1% for the Eurozone as a whole. And even in Germany, retail sales, they fell 0.3% in March. The previous month's gain was revised to a fall, so we've got back-to-back falls in retailing there. The annual pace of decline in retail in Germany is 2.8%, so almost 3% less stuff being bought in March this year than March last year. These figures are adjusted for inflation, by the way, well, what inflation there is. The latest German unemployment figures showed a 4,000 rise, although the unemployment rate there, measured on a different basis to the European ones I mentioned earlier, is 6.9%, and it's steady. But the point is that German unemployment falling is no longer offsetting higher unemployment elsewhere, and that's why we've got these new records being reached pretty much every month for the Eurozone as a whole. We had some UK data, including some slippage in consumer confidence in the latest figures there. In the US, a mix of numbers, a very modest 0.3% increase in the employment cost index in the first quarter, indicative yet again that the labour market's not putting any pressure on wages or more generally inflation, although there was some question about, by the statistician, about some of the quality of the data. But even so, there's no question that the labour market's still pretty loose. We had house prices accelerate to 9.3% annual growth, according to the Case-Shiller Index for February. That's the fastest pace in 7 years. The factors driving it are very reduced supply of houses. Just to give you some numbers, the number of houses on the market for sale is 1.9 million in the US at the moment, and that's only 4.7 months supply at the current sales pace. Now, the all-time low for that sales pace, or that supply, is 3.6 months worth back in 2005. And it peaked at about 12 months worth of houses available for sale in 2010. So this glut of houses for sale in the US in the last couple of years has very rapidly diminished. Apparently a lot of investors are snapping up houses at prices they think are a good value. Remember, prices, even though they've been rising, they're still down on average 29% from their peak back in 2005. And rental returns are apparently pretty good. So that's putting some upward pressure on prices, and hopefully putting pressure on the new build sector, which is where the jobs would really start to come through from. It's a necessary part of a sustainable recovery in the US economy, but still early days. The Chicago Fed's factory index for April, it fell very sharply from 52.6 to 49. It's the first sub-50 reading for that index since the closing days of the recession in 2009. So that generated a bit of concern. It's worth pointing out, though, that as with all the business surveys in the US, they've been following similar patterns. That is, looking okay at the start of the year, then falling away in the middle of the year, then picking up again later in the year. Could be a seasonal adjustment issue or some sort of other measurement issue that's affecting these surveys. Although it's apparent in other data too, even the jobs data, for example, have been strong at the start of the year and then fall away in the middle of the year. And we're seeing that with payrolls. Other data in the US, consumer confidence, it bounced from 62 to 68 in April. although the consumer's assessment of the labour market was it deteriorated somewhat, fell to a 3-month low. That jump in consumer confidence merely reversed the dip in the previous month, which reversed the jump in the previous month. Basically, that measure of consumer confidence from the Conference Board has been running in a fairly tight range over the last year and a half, after absolutely plunging between 2007 and 2009. The other data today worth mentioning just quickly, in fact, no, that's probably about it. They're the main points. There's some Canadian figures that are out as well, but nothing really major there. Given all of that and intensified expectations of a European Central Bank rate cut on Thursday, and we've got the FOMC meeting and their announcement, their statement tomorrow, markets kind of been treading water. I'll give you the numbers just ahead of the close in Europe. The FTSE down 0.5%, the French market down 1/3%, the Germans up 0.5%, Spain down 0.3%, and Italy down 0.9%. And the Dow at about 4:45 in London is down 0.05%, so effectively unchanged. It's at 14,811. And on the commodity side, copper prices have pulled back a bit after recovering somewhat. They're 1.4% lower, 318 cents a pound. Oil's off just over 1% at $93.42 a barrel, and gold's unchanged at $1,467 an ounce. The Aussie dollar, it's at 1.037 against the US dollar, just a little bit higher. And that's about it for me today. I'll be back again tomorrow with the update, which will include, well, we've got the ADP private payrolls measure coming out, an early clue to Friday's jobs report in the US, and of course the Federal Reserve's decision. Okay, back tomorrow.